I'm joined by Wraith. He's fixed income strategist at Bank of America Merrill Lynch. So who is right?
Well, they've both got a point. I think if you look at the recent data in Europe, it's fair to say that things have taken a significant turn for the better, whether it be in the underlying growth numbers or the stresses and strains in the banking system. But clearly in the US there has been a worrying turn lower in activity data there. Our suspicion is that ultimately what goes on in the US will feed through into the wider global economy, and that therefore I guess we'd lean more towards concern about the future rather than being too upbeat about what's just happening.
And the other factor you have at play that Joseph Stiglitz just talked about is when you have all of these countries in Europe engaging in these austerity measures all at once in concert, we don't know what the results are going to be.
No, and there have been episodes of severe fiscal tightening in all sorts of countries in the world in the past, which have been successful, but typically you need growth somewhere else to be strong so that you can export your way to a degree out of trouble, and therefore the fiscal squeeze at home doesn't hurt so much. The problem now is, as you say, that everybody is going to be tightening at the same time, potentially, and therefore global demand in the sum is going to be weaker than necessary, and it does make the equation very hard to round.
So that means everyone's going to be depending on China?
Well, potentially so, but then of course China's growth model has been driven by exports, so they too need demand elsewhere, and it is hard to see, as I say, how things add up to us.
Let's talk more about what Trichet had to say. He was talking about the bond market stabilizing in Europe. What's the outlook there? What's the impact, Ben, of the ECB's program?
Well, the bond market has stabilised, undoubtedly. I mean, yields are indeed still falling quite dramatically. So any concerns about oversupply and the issues that peripheral Europe faced earlier in the year seem a long way away at the moment. But when you consider that bond yields ultimately are telling you where growth and inflation are expected to go, the fact they're so low now, and 10-year German bond yields are not far off 2.5%, it doesn't actually hold that much hope for strong growth and reasonable levels of inflation over the coming years. What
happens when the ECB starts to wean the banks off of unlimited fundings? What happens as it moves further towards this exit policy?
Yeah, I mean, they're already certainly well underway with that process, and Trichet was talking about it yesterday. He's obviously monitoring the way the banks are able to fund themselves now through the interbank market to a greater degree. And so far you are seeing these lending rates start to rise quite materially, really, on a relative basis. But he's attributing that not to signs of renewed stress in the banking system, but more to a healthy normalisation process. But it's one to watch for sure. Now,
with regards to the UK, I mean, do you think the Bank of England moves towards an exit next because of inflation, or do you think they've got to look at more QE?
Well, we think, the growth in the second quarter was very strong. Activity coming into the third quarter is very upbeat. But a bit like in Europe, we're more worried about what's coming next than sort of patting ourselves on the back about what came before. And I think they're rightly looking to offset the fiscal tightening that's coming with a very accommodative monetary stance. So as long as inflation does keep on edging lower, which we think it will, then we expect them to stay very much on hold for several months at least.